Welcome to this Killik Explains finance video. This week, 5 vital terms for dividend investors. Now, a quick reminder. If a firm makes an annual profit of £100 million, what are its choices? Some firms will retain it all and keep it in the business. That's not the kind of firm we're looking at this week. We're looking at firms that pay a decent chunk of it out as a dividend and asking, can we trust the firm to keep doing it? There are, in practice, of course, companies that do a mixture of the two. So let's focus in on box 2 here and look at 5 key words that would reassure you that this is a good bet. Now, the first one is credibility. You want a company that shows a commitment to income, not just a promise in 1 year. So, we want a stated dividend policy. We want a 5-year track record of meeting that policy, and you can look back, this information is available, and we want a stable trend in both earnings and a favoured measure of fund manager Terry Smith, return on equity. More about those in other videos, but that will give you some indication that the dividend is credible. Next, affordability. Does the company have sufficient cover for this year's dividend? Because that will give us a warmer feeling about next year's. So, does it have decent and consistent profit cover? In other words, is the profit before they paid out the dividend a decent multiple of the dividend itself? 2 is a good number. That, in the real world, can be difficult to find, but the higher the better. You certainly want to be questioning a firm where the profit available to pay a dividend is less than the annual dividend. Equally, does it have cash cover for the dividend? It's not just window dressing. Is the cash flow statement offering you decent cash cover for the annual dividend? And is the balance sheet strong enough to maintain dividend payments? That's all about reviewing gearing levels, debt to equity, and CapEx, which I'll come back to in just a moment. Next test, sustainability. Can they keep it up? In other words, is the company's past looking like a reliable guide to its future? So, in brief, a dividend target that's measurable and consistent. If they've always said we'll pay a dividend and increase it by inflation or inflation plus 1%, have they actually done that? Secondly, stable expenditure plans, because things that can go wrong in the future include sudden spikes in CapEx, unplanned, unfunded, replacement of assets and so on. So let's get a grip on that one. And thirdly, is management communication clear and consistent? Do you trust management to deliver not just on dividends but elsewhere too? Diversification. Income investors should reduce single stock risk. All investors should reduce single stock risk. Simple reasons. Any firm can suspend or cut its dividend. Look back in recent years at BP, Tesco, G4S, they've all done it. A portfolio of 15 to 25 stocks will do the trick if you're looking to diversify most of the single stock risk away. And make sure that you understand you're still exposed to market risk. This is the risk of the whole market tanking, but as an income investor, so what? Hang on in there. You're looking for headline income. Just because share prices go down as well as up doesn't mean companies can't sustain their dividends. Finally, reinvestment. This is powerful. As far as possible, don't spend dividends, reinvest them in shares. Now, dividends can account for over 50% of the stock market's long-term returns, whether you're looking at the S&P or the FTSE 100. Plenty of studies show that. So, dividends are important. The key is to put them back into stocks. Okay, so by reinvesting dividends, you'll achieve 2 things. You'll boost your total returns considerably, and you'll reduce the volatility of those returns. And that's the key. The power of your invested pound is magnified. Quick demonstration, the past is no guide to the future. On a capital-only basis, had you invested £1,000, all right, in the FTSE All-Share in the early 70s, the start of the worst bear market we've seen recently, 2016, according to Barclays, you've had around £18,500. Not bad. 18.5 times your starting investment. But if you look at this on a total return basis, reinvesting those dividends, ploughing them back in as you go, suddenly the £1,000 you start with pops up to a more impressive £108,000. Again, the past isn't a guarantee of future performance, but you get the picture. So there it is. 5 key words that income investors should have, if you like, chalked on their forehead. Any questions? editor@killik.com. And to see other videos on this topic and some of the buzzwords I mentioned in this video, please go to killikexplains.com.